I'm Becky Quick of CNBC and your host of The Forum. I'll be guiding you through exclusive conversations among some of the world's global leaders. Conversations previously held behind club doors, but today we invite you in. The Economic Club of New York serves as the premier forum for nonpartisan discussion dedicated to connecting the world's brightest minds with preeminent public and private sector leaders. A nonprofit 501c3, the club is a 115-year-old platform for the conversations that help shape the future of our world. The Economic Club of New York, brightest minds, critical conversations, catalyst for innovation.
Mohamed, I'd love to start with your thoughts as an opening gambit on tomorrow, which is the Tariff Liberation Day. Love to just hear what you're thinking before we get into the markets and to the macro.
I don't know what's going to happen tomorrow. I don't think anybody knows what's going to happen tomorrow. We don't know what other countries' reaction is going to be to what happens tomorrow. And that amount of uncertainty has resulted in a significant change in narratives. 3 months ago, it was unthinkable that the US stocks would suddenly plummet. It was certainly unthinkable that US stocks would underperform other countries by the most in over 2 decades. It was unthinkable that gold would continue going from record level to record level. It was unthinkable that the embracement of US economic exceptionalism was going to be replaced by anxiety about stagflation. It was unthinkable that Germany would have a Sputnik moment and would constitutionally change its debt brake, the limits on brakes. All that has happened over the last 3 months. And we're living right now where we have enormous consensus that we are in a period of disruption, disturbance, a bumpy journey. And then we have completely polar opposite as to where that journey leads to. And there are 2 destinations that are equally credible. And I don't think anybody knows for sure where we're going. So I say this because there is no easy way to answer tomorrow. What you can hope for is tomorrow is a one round, and I'm going to use game theory terms, not because this is a game, this is not a game, but because when you're in negotiations, game theory really sheds light on what you need to know. What type of game is it? Is it cooperative? Is it uncooperative? How equal are the players in negotiations? What is their view about the game itself? Is it one round? Is it multi-round? So if you want a good outcome tomorrow, it's a one-round game in which the US forces its trading partners to treat it fairly. Other countries don't engage in a tit-for-tat response. And we transition to a world where it's a fairer trading system, with other countries carrying more of the burden for common public goods. That's the good outcome for tomorrow. The bad outcome for tomorrow is that other countries do not believe this is a single round game. They believe there's no point in agreeing to anything. And they decide to put counter tariffs on. And then the question becomes, what does the US do in response to that? So this is, Dambisa, how uncertain tomorrow is. And I think the key issue is ultimately, will this be a single round game, which was what happened in 2017? Or will it be a multi-round? And we will end up talking about this for the months to come.
So, Mohamed, I think that that's fantastic in terms of clarifying the option. I wonder if we can also take a step back and ask you to just offer us a snapshot of the global economy. I mean, one of the things that you do so well is not just focus on the US, but just give a broader context. And you've touched on it a little bit, talking about Europe struggling right now. You touched on China, but could you just talk to us, where do you see growth? Obviously within that, we've seen recession probabilities increased over the last few days. Where are you on recession? And you've just touched on the point about stagflation, which we'll come back to, because I'm very curious to push you on what you think the policy response should be. We know about markets and what's being priced in for rate changes this year. But before we do that, just take us through a very quick view on where you see the global economy at the moment.
It used to be dead easy, really dead easy. I used to call it the good, the bad, and the ugly up to January. The good is the US. Economic exceptionalism, a Federal Reserve that can lower interest rates for good reasons. Inflation is continuing to come down. The bad is China, stuck in this muddle middle of policy, becoming more like Japan. Growth is sluggish. Inflation turns negative. The household sector says, what's the point of consuming now when I can buy things later, cheaper tomorrow? Requiring what's called a bazooka stimulus, throw everything at it to avoid Japan, but a growth engine that's out of date. If they crank it up, oil will spread all over the place. There's a lot of collateral damage. And the other policy choice is to reinvigorate the growth engine and accept lower growth. And the Chinese government has been looking at these two options, doing a bit of this and a bit of that, but not enough of either. And the situation getting worse. The argument, we want to wait and see what the US does. So the bad was China, and the ugly was Europe. Europe stuck in a structural trap with the wrong growth model completely, the wrong industries, and unable to embrace innovation, and its most powerful economy with a ton of fiscal space, Germany, not using it. It was a simple world for me then. The US would grow at 2.5% to 3%. Today, I suspect we're looking at 1 to 1.5%. That is how much the outlook has changed. 1% is near what economists call stall speed. Think of yourself on a plane. The plane could still be moving forward, but if it's not moving forward fast enough, it will lose altitude. If you're running businesses, you need a minimum amount of growth in your business to allow you to do the changes that you need in that. So we're now looking at US growth of 1 to 1.5%. We're looking at inflation at about 3%. We are not going to get good news interest rate cuts. If we get interest rate cuts, it will be bad news interest rate cuts, because the recession risk, which is currently about 30 to 35%, goes above 50. So the US outlook has changed quite a bit. China hasn't changed. Europe is having the possibility of its Sputnik moment. Europe has really been shaken in terms of its ability to rely on the US for national security. And that has caused Europe to revisit the way it does things. And part of that revisiting is the unleashing of fiscal policy in Germany to spend on defense, to spend on infrastructure, and to spend on European-wide project. So Europe has the ability now to climb out of the ugly. But what it needs to do, and I warn this because the market has got carried away completely, the European 600 stocks have outperformed the S&P by 17 percentage points in the first quarter. That is enormous. Why? Because the market thinks that what's happening in Germany is not just necessary, but it's also sufficient. It's not. Anybody who's read the Draghi report knows how deep the structural problems of Europe are.
It's the Draghi report on productivity, which came out in the autumn of last year.
Correct. So, we now have lost the US as the main engine of growth. Europe has somewhat better prospect, and China is still stuck in the middle.
Would you like to be a part of the conversations at the Economic Club of New York? Learn more about membership, the New York City and National Fellows programs, and other opportunities for engagement in the club at www.econclubny.org.
So one thing that I think is quite interesting is you and I actually are from the continent of Africa, and you haven't mentioned anything about emerging markets, which is where 90% of the world's population lives. I wonder if that's an accident, or are we supposed to impute from you not mentioning it that there's something perhaps worrisome, that's also worth stressing. And we hear about the BRICS, we hear about swing states, reconfiguration of many of these emerging economies. Just any perspective on what's going on there would also be helpful.
You know, there's a story that when the US and the Soviet Union at the time started becoming less of enemies and more friends, of an African leader saying, "What does glasnost mean for you?" And he said, when it was the Cold War, we were the grass on the two elephants fighting. Glasnost, we are the grass on the two elephants dancing together. It still hurts. Part of all that is that the rest of the world is in a difficult situation unless you are what you called a swing state, unless you have something to offer to all sides in this multipolar world. So swing states are Saudi Arabia, UAE, Turkey, India, Brazil. They can offer things to both. And they can play both sides. And actually they do it relatively well. But most countries are not able to be those swing states. So they're very worried. They're really worried. They're worried about international trade fragmenting. They're worried about growth, global growth coming down. And the question I get asked most often, and it has to do with gold, it has to do with other things that I don't think the US realizes, is how does Russia do it? So you, Mohamed, and other economists told us that the minute Russia is excluded from the SWIFT, from the dollar payment system, it would collapse. Its economy would collapse. And yet Russia is trading. It's trading without using the dollar at all. The answer, of course, is it has a very complex, inefficient trading system that's an alternative to the efficient trading system. It involves 4 currencies. The dollar is never touched. Russia probably operates at 60% of what it would otherwise be. And because the US hasn't imposed and the EU haven't imposed secondary sanctions, other countries, India, China, find it in their interest in this axis of convenience. But the problem is when you start an alternative payment system to the dollar, and countries started getting interested in how it works, you can ultimately, over time, erode the dollar payment system. And that for the US would be a real problem. Same thing with gold. Gold has gone from record level to record level. It has broken every single correlation it has had. Gold has gone up when it's been risk off. Gold has gone up when it's been risk on. Gold has gone up when the dollar is strong. Gold has gone up when the dollar is weak. It just keeps on going up. And the reason why is because central banks outside the US, at the margin, are diversifying away from the dollar. There's no other currency to replace the dollar, but the influence of the dollar can slowly erode. And what's happening to gold prices is an example of that. So it's really important, and I'm glad you asked Dambisa, is to ask, how does the rest of the world see what's going on right now? And what the rest of the world is saying is, I'm not sure I like the implicit contract that was so important since the Second World War, which is the US is at the core of the system. We get incredible privileges. We get to have the dollar as the reserve currency, which is another way of saying, I give you a piece of paper and you give me goods and services. I love that. Of course, we want to exchange pieces of papers for other people's goods and services. The US is the financial center of the world. People outsource their savings to us, which means we have more capital than we would otherwise. The US has veto power over really important decisions at the IMF and the World Bank. These are all privileges in an implicit contract where the world was willing to give us these privileges in return for us managing the system responsibly. 2008 crisis originates in the US. The first round of weaponizations of tariffs and investments, US. Non-cooperative behavior during COVID vaccines, US. So the rest of the world is now questioning this implicit contract. And that certainly for my kids is not a good situation to be in. We have time, but you don't want to get too close to when the rest of the world gets to critical mass, building little pipes around the US.
So, Mohamed, lots of questions emanating from what you've just said, and I'm going to probe a little bit further on this question about the dollar. You would have heard about the Mar-a-Lago Accord, questions about whether there'll be some form of debt restructuring. We know that many countries, developed countries, now have debt to GDP ratios around or above 100%. We also know that there are real concerns about the U.S. government spending more than they are on three, and that's the Adam Ferguson rule, which has been going around quite a bit now. I'm sure many people are aware that that's usually taken as a sign of the sort of the beginning of the end of a domination of a country, is when the government's spending more money on interest than they are on the military. Just talk to us a little bit about the Mar-a-Lago Accord, what you think these types of proposals or discussions might mean. I know you also serve on the G30 group. What should we be thinking about in terms of where the dollar is? What does it look like in terms of its future, and with the debt dynamics in the background also?
So whether it's debt or other things, the US has a much longer runway than any other country. And that's because most of the time we solve in relative space and not absolute space. So what do I mean by that? Think of you being on a business trip, and you're a very efficient packer. You've got the exact amount of clothes for the length of your trip. And then suddenly a storm hits and you have to stay an extra day. And there's no way you can get your laundry done. What are you going to wear? You're going to wear your cleanest dirty shirt. You're going to wear your cleanest dirty blouse. The US is the cleanest dirty shirt in the global economy. It's not pristine, but it's a lot better than the alternatives. And when it comes to the bond market, when it comes to the safe havens, it is the cleanest dirty shirt that wins on this. So while I hate our debt dynamics, I don't think we are at a tipping point, because we are actually cleaner than a lot of other countries. It doesn't mean you should postpone what you're doing. What should you do about debt? There's only 4 possible solutions, 1 good one and 3 bad ones. The good ones is grow faster. Capture what I think are really exciting productivity enhancers in our future. I'm super excited about the coming together of the AI innovations, life sciences, robotics, and in about 5 to 10 years, quantum. I mean, that is so exciting. This will fundamentally change how we do things. And the productivity gains to be captured if we manage this well, and it's an 80-20 proposition, 80 good, 20 bad, so it has to be managed, are enormous. So the best answer is to grow faster. The second one, if you don't like that, is financial repression. It's some sort of accords where you force creditors to accept lower payments. And we did this. We took interest rates to 0, which meant that we subsidized debtors and we taxed creditors. Europe took them to negative. You know, this notion that you lend someone money and you pay them for the privilege of lending you money. It's absurd. 30% of government debt was trading at negative interest rates. So the other thing is to do this financial engineering, but you fundamentally distort the allocation of resources in your economy. You create zombie companies, you break things. The third thing is austerity. Now, austerity works for a while, but austerity cannot be done over and over again. And then the fourth one is you restructure your debt. The US, in addition to being the cleanest dirty shirt, has the biggest potential for productivity gains in the next few years. So I do worry about our debt dynamics. I think we can grow out of them. I really do. But it requires that we enable these innovations that will fundamentally alter how we do things.
You've been listening to The Forum by the Economic Club of New York, a nonprofit 501c3 dedicated to connecting the world's brightest minds for critical, nonpartisan conversations. Be sure to subscribe now to be alerted to future new episodes. Would you like to be a part of the conversation at the Economic Club of New York? Learn more about membership, the New York City and National Fellows programs, and other opportunities for engagement in the club at www.econclubny.org. I'm your host, Becky Quick. Thanks for listening.